G'day, Trent Fleskens here from Strategic Property Group, and today I'll be talking about the type of people property investment is not suitable for. Whilst it's easy to get caught up in the hype, it's important to remember that property investment, like all investment, is not a risk-free game, and it's not for the lazy investor. Like all investment options, it's imperative that an investor knows his product, knows his market, and has a keen eye on the future to develop a solid grasp of expected returns. The first type of person who should not be investing in property is the person who wants a quick win. Unlike shares, where money can be made and lost in a matter of seconds, property investing comes with lengthy transactional lead times and costs, and you want to be in for the long run. It's not a game you want to be jumping in and out of, and it's certainly not a game you want to be betting against. But for those who understand the potential of leveraged investment of physical assets and diminishing supply, the property market offers a unique opportunity to supercharge your retirement fund. The second type of person who should not be investing in property is the one who wants to start small with just a couple of $1,000s. And while some lenders will lend to people with a couple of $1,000s, the associated costs of LMI, stamp duty and fees can put you seriously behind the eight ball before you've even started. Unless you are purchasing to live in the property, sometimes it's a bit better to dip your toes in the more liquid share market before taking on such a huge step straight off the bat, contrary to what some property spruikers will tell you. The third type of person who shouldn't be investing in property right now is the one who is only buying because they're scared of missing the cycle. FOMO. These are generally the people that buy high and sell low, forever burned by the market. In extremely fervent and heated markets, it's easy to get a bit carried away and pay more than the house was ever worth. But it's so easy to do so when one of your strongest emotions, fear, takes over. So much of the equity in your property isn't just made over time, but on the great deal you negotiate at purchase. So if you're already paying too much, you're already behind the eight ball. The fourth type of person who shouldn't be investing in property is the one who doesn't have a clue where his current finances are going, let alone those of a new debt. Whilst you may have the income and equity to jump in the market today, if you're unaware of your monthly budget, it can be very risky to throw in a big new obligation without understanding the full potential of where that could leave you if things go awry. It will also leave you vulnerable to being slow to react when a tenant may not be paying their rent. It can sometimes be too late to reverse the pain. The fifth person who should not be investing in property is the one who doesn't know their product. So often people come to me showing me flyers from spruikers based in Queensland, offering big numbers and returns all over the place. And when I ask them where the property is or where the suburb the property is in, they couldn't tell me. They've been sold on the idea of property investment without actually understanding and customizing themselves to the critical factors that will influence the performance of the asset they are trying to buy. So straight away, if you don't know the suburb, if you don't know the demographic, if you don't know the local schools and sporting team, you should not be buying that investment property. The last person who shouldn't be investing in property is the guy who wants to get in to reduce his tax bill at the end of the year. As we discussed in a previous session about negative gearing, a tax refund only comes to you on money you've lost. It's a safety net. In no way is it an income generating machine. So whilst it's nice to have a bigger tax return than usual, it's imperative to make sure all the numbers actually stack up on the capital growth and cash flow side before you simply buy a place with a couple of thousands of dollars a year in tax refunds.